Troy White, Hoodoo Financial, and I wanted to pick up where we left off, and I want to put more emphasis on how trust is embedded in the blockchain. And the thing about the blockchain is that it is a trust protocol. It is referred to as a trust protocol, and it is a trust layer that has been placed over the internet as a whole. So transactions that take place across blockchains, on blockchains, are occurring with trust built into them. Now, cryptocurrencies the are the currency that's going to allow business to transact on this trust layer, and um, and current cryptocurrencies are also referred to as tokens fundamentally, and you may hear about the tokenization of the economy, and what that refers to is that cryptocurrencies and the blockchain are becoming an essential part of the business operations, and all business that takes place on a blockchain uses tokens. Tokens are what Bitcoin is a token. It's a cryptocurrency, also referred to as tokens. So blockchain fills the trust gap, and it enables trust to exist in business because currently businesses cannot trust each other. We have to find ways to trust each other. We have to have legal agreements and whatnot, and even then, we're tentative to transact with each other because we cannot necessarily trust that things are going to happen. And trust in infrastructure affects our economy. If there's no trust embedded, economy has systemic barriers. And those systemic barriers occur when at every point in a transaction where we cannot confirm that one entity is going to perform um, its duties, basically. And with blockchain transactions, they can be trusted because they are immediately recordable and the records are immutable. Immutable refers to the fact that once this digital transaction has occurred, we have a permanent record of it. It cannot be altered. We know exactly what has happened. And so that's where the fundamental benefit occurs. So there's a trust gap, and blockchain seeks to fill that gap. And you may have heard trust but verify often in business. So that means we can trust that they're going to do what they said, but we need to verify that the money is there, that they're going to do what they said. You know, and so for the blockchain, we must have trust to have these business transactions, and that is central to civilization. In civilization, in commerce, we must have trust, or it just does not function. And so when we have dysfunctional economies, you're going to find that it is because there's no trust there, or there's some sort of trust barrier. And economies that are dysfunctional, like the African American economy, is a sub economy in America, economy that is identifiable, that has weaknesses, that has, you know, as aspects that don't function properly, high levels of unemployment. Well, why? That's because there is distrust embedded into our economy. And that distrust is between the participants, the outer economy, and those of the inside the African American economy. Meaning, at each point of where there's a trust protocol, a trust decision to be made, that involves a human, then there is a bias. And too often, those biases are negatively impacting the African American economy, the side of the African American economy. And so the blockchain solves that issue. So what we have found is ways to manufacture trust into this economy. And the trust is established by relying on third party intermediaries. So though currently we rely on third party intermediaries um, like escrow departments, like transfer agents, like I'm in the financial services industry, and I can give you a long, lengthy list that you wouldn't even understand what I'm talking about, though, of the third party intermediaries along the chain of business transactions, specifically financial transactions, that these intermediaries basically are confirming that this happened. Yes, the money is in this account. Yes, the money, there is an account over there to transfer this money to. Yes, we acknowledge that this funds can be transferred over there. There's a yes and no angle all along the route. And remember, anytime someone sticks their foot in your transaction, they're sticking their foot, they're dipping in their spoon and taking out a piece of the pie. They want some payment for the authorization of this. So this lack of trust costs, and it costs a lot. And okay, so these intermediaries cost money. Intermediaries also rely on other intermediaries, and they facilitate the interaction between those who wish to trust and those who wish to be trusted. And these intermediaries have to be paid. This is what I'm getting to you. So examples of these intermediaries. Banks are these intermediaries. The DMV is an intermediary. Title company, a credit agency. All of these intermediaries are inserting themselves into transactions because we can't trust no one in each other at all. So in the terms of a credit agency, two parties want to do business, but one cannot trust the other that you are trustworthy to do business with. That's why they check with the credit agency. Now, a title company is an intermediary. Two parties want to do business with each other. One wants to buy a house, one wants to sell a house. Well, this intermediary inserts themselves in this transaction because the two parties don't trust each other to pay to each other. One doesn't trust that what they're going to get is what they are being advertised in terms of this property, and the other can't trust that once they sign these papers over, sign this house over to you, the money's really going to be there in the bank. So we have to have these intermediaries. Same with the DMV. DMV is the repository of identifying you are who you say you are, so that other users can use this as a repository of the fact to whom you are. Banks are those intermediaries that you can trust to determine, yes, this person has this $20 in the bank that they say they're gonna pay you for this product. And so businesses have automated assumptions that businesses automatically assume that the person they're doing business with can't be trusted, and that's why they involve the intermediaries. So trust in itself is an intangible asset that has value to it. Intangible assets have value. So this trust can be valued, and that value can be tokenized. We can embed that value into the token. So if we can calculate the value that is, then that's why intermediaries charge us. They charge us X amount to verify that this money is in here, or to verify that you are who you say you are, or to verify and do the escrow process, all of the verification that takes place in there. So we can quantify that trust by how much the intermediary is charging us. Therefore, if we can replace that trust with the blockchain, with technology, that means we can remove those costs that we can quantify. So there is that, and that is the intangible value of that trust right there. And so like systemic risk and has a percent is embedded in your percentage rate that you receive on investments. So the blockchain eliminating systemic risk in itself, that that's a finance nerd's understanding, but that's just a piece of the technical explanation as to how the blockchain has actual value in financial transactions, and it diminishes the potential for risk. And by diminishing that potential for risk, we increase the value. So trust is fundamentally what the blockchain is transacting in, is eliminating, or is replacing, I should say. It is embedding trust in transactions, and that in itself is an amazing thing. We'll talk more about it later. I'll leave that on you to marinate with.